Welcome to our webinar today, 2020 Directors and Officers, Risk in Time of Crisis and Change. I want to send a special thank you to Heffernan Insurance for being our co-sponsor for this webinar. I'm also very pleased to introduce our wonderful panel of speakers. I will do a very brief introduction as you all have their bios from the invitation. John Burke is Divisional Vice President, Management Liability, Western Region for Financial Lines at AIG Commercial Insurance.
Morning, everyone.
Melinda Guzman is CEO and Managing Attorney at her own law firm, Melinda Guzman Professional Corporation, and an Independent Director of the Federal Home Loan Bank of San Francisco. Kevin Lacroix is author of the internet blog, The D&O Diary, and an Executive Vice President at RT Pro Exec, an insurance intermediary focused on management liability issues. Ignacio Salceda is a litigation partner at Wilson Sonsini, Goodrich & Rosati. And our moderator for today is Joe Talmadge, who is the Senior Vice President and Technology Practices Leader at Heffernan Insurance Brokers. Today, our panelists will speak for roughly 30 to 40 minutes, and then we will open it up to question and answers. I do encourage you throughout the presentation to actually submit your questions via the Q&A option on Zoom. You can also use chat as well. And we will be recording this session for later viewing on our website.
Good morning, everyone. Thank you, Nancy. Could you go back to your slides? Because I've got some good data that I think will be easier to follow if this audience can see the numbers.
Absolutely. Let me get the share screen back on. There we go.
So thank you, Nancy. So this slide and the next two slides were provided us by Cornerstone Research, who very graciously allowed us to use these slides for today's webinar. And what this slide shows is the annual number of securities class action lawsuits filed in federal and state court from 2005 to 2019. The colors on the slide differentiate between mergers and acquisition filings, that is lawsuits alleging that there was inadequate disclosure or inadequate compensation in connection with the merger transaction, and that what we call core filings, which are the misrepresentation or omission cases about financial condition or operating results. The D&O insurance industry watches the data in the slide very closely because the frequency that's reflected directly affects their underwriting results. And so a year with significant numbers of securities class action lawsuits can be very detrimental to their underwriting results. And everyone can see that for the period 2017, 2018, 2019, the numbers were much higher than long-term averages. Now, part of what's going on during that period is there was a shift to federal court from state court of merger objection lawsuits. Now, if that were all that was happening, this information would be far less important than it is. If you look at the blue part of the bar, you'll see that starting about 2010, the number of core lawsuits went up slightly every year to the point that by 2019, it was the highest level during the period reflected on this slide. If that were all that was going on, that would be bad enough, but there was more going on at the same side. So Nancy, could you flip to the next slide? This slide presents the data in a slightly different way. Rather than simply a number of lawsuits, it's a ratio, the ratio of number of lawsuits to the number of US listed companies. And you can see that the long-term average was 3%, meaning about 3% of the listed companies in the United States got hit with a securities lawsuit each year. Well, you can see that, again, beginning years ago, that number started creeping up to the point that in recent years, it's well above long-term averages. And at the highest level ever in 2019. The reason it's going up is not just because there are more lawsuits. There are fewer companies. Since during the 21st century, the number of public companies has declined significantly. So what that means is as more lawsuits come in, the ratio goes up. To put it in simple terms, the chance that a US listed company gets hit with a securities class action lawsuit in 2019 at 8.9%, 1 out of 11. It's fair to say that the D&O insurers for many years were not pricing for this level of frequency. And as those numbers were going up, we were actually coming off a period where in fact pricing was going down every year. And at some point, those lines had to cross, and that's what John is going to talk about in a minute. But just very quickly, we are halfway through. Nancy, if you could flip to the next slide. We are halfway through 2020, so we can ask the question, has that trend from the last 3 years continued? And the answer is mostly. What you can see is if you annualize the 182 lawsuits filed in the first 6 months of 2020, we got 364 securities class action lawsuits, which would be not as high as 2017, 2018, 2019, but higher than all prior years. And this slide presents the data slightly differently. It breaks down the core cases into Section 11 cases, that is, in connection with securities offerings, typically IPOs, and then open market cases, 10b5 cases. And you can see that where the drop-off was in the first 6 months was with respect to the merger cases, the IPO cases. That's really not that surprising because for much of the first half of the year, as a result of the coronavirus close down, there weren't mergers happening and IPO activity was off. So it looks like it may just be a lull, but even if it continues at that lower rate, it would still be well above long-term averages. So that's my answer to that question, Nancy.
Great, thank you, Kevin. And I'll just keep my slides up and we'll pass it along to John. And talking, now that the first half of 2020 is done, can you share the D&O underwriting perspective on the market?
Sure, thanks, Nancy. And that's a good follow-up and segue from Kevin. And we hope there are some silver linings in the 2020 year-to-date stats. It's a small sample size, but I think we'll get into a little bit deeper with Kevin and Ignacio as respects COVID. But a lot of the recent headlines that I included were kind of regarding the core securities cases and M&A filings. Kind of, if you look at things earlier this year and the way we ended 2019, as Kevin mentioned, were particularly challenging. And we have some analyst comments too, as respects how the outside world views our industry. Here's one from AM Best. They started looking at us as a carrier and broker industry and what was going on. And there's some snippets of emerging risk and greater complexity. I think Kevin talked about the federal and state jurisdiction. And then we have some details that Ignacio and the team are going to talk about as respects derivative lawsuits, so cases brought on behalf of the company against some of those individuals for breach of fiduciary duty and the like. So the complexity challenge has really been one of the areas where we've had to stand out as a primary carrier, and our strong brethren too, as respects other carriers, have really had to step to the plate because of how complex securities class actions have become at the record pace. So we call that the frequency and severity issue that our industry sees. So that was the AM Best referral, and then NERA as respects average case size surges. And I think most of the people in the audience, Nancy, are probably more specifically geared towards U.S. companies, and U.S. settlements, unfortunately, have been higher. We'll talk about that too, but the settlements for U.S. listed companies and domiciled in the states, regardless of the state that the lawsuit is brought, we're seeing 20 to 25 million as respects our slide, which is a little bit lower for some of the foreign companies. So that's a challenge. And then this third slide, I know Melinda will speak from a board perspective, and it's not just public companies. There are now private company executives and private companies taking advantage of the ability to be a strong prowess company on the private sites, as well as investments in the NASDAQ private market and the like. So companies are staying private longer and having some of these issues. And now the SEC and the DOJ are starting to look at private companies as also being exposed to the same or similar regulations as public companies. And I know that Kevin and his team are trying to track that. That's been difficult because it's not as fluid a market and transparent as respects who's actually sued because of the non-filing with the SEC perspective. So we had some challenges going into this year that we were taking action on and prudently and trying to make sure that our companies don't have the carrier population to worry about from a solvency and profitability standpoint. We now have the issue of just helping them with their dilemmas as respects being a public or private company in this market. So I if we can go to the next slide, Nancy, which will give a little bit of a detail of the collision course that Kevin was talking about. And unfortunately, during those years, I think that Kevin cited where cases started to creep up, there was a lot of capital that had come into insurance, and a lot of carriers were taking advantage of some ability to bring more capital into the market, invest in D&O, and not thinking that that the losses would be there. So premiums were driving down, and the cost of capital started to come up. So we had that train wreck kind of happening where cases were increasing, but premium levels were coming down, and carriers were maintaining their business, but not seeing yet the real nature of the securities class actions hitting. Although for those years, going back, AIG still has some open inventory going back to 2010 and 11 even, but more so the past 6 years. There are now more than 800 cases. These are all across the industry, not just our population, but there were greater than 800 cases at the end of last year that were still in the inventory. We call them SCAs, mostly core filings, like Kevin alluded to, that need to be settled. And if anybody from a board perspective has been involved in them, they're not very easily to dispose of, and you have to get everybody online. So we're seeing that average continue to be 2, 3, 4 years to dispose of that inventory. So hopefully there's a trend where 2020, the first half was a bit of a lull, gives us a chance to catch up and take care of some of the older cases and move on. But I think Ignacio and Kevin will talk about it a bit. We're cautiously optimistic, but concerned about what the latter half of the year might bring for us. So we're doing the right thing as respects our clients. The interesting note too that Kevin brought up is the percentage of public companies that are now privy to a lawsuit. So that's something I know from the board perspective, Melinda, you're probably hearing where more folks were immune from litigation in the past, and now that 8 to 9% number also follows through. And the interesting thing that a lot of the primary carriers are tracking is that it's hitting a lot of solvent large companies. So the S&P 500, those largest companies are now seeing litigation. And like Kevin said, it's not always run-of-the-mill stock drop cases. There are derivative suits. There are breach of fiduciary duties. There are things that larger companies are being hit on antitrust-wise. So a lot of those things that were not clearly D&O drivers are now part of it, and we have a little bit of that to talk about too. And I talked about the average settlement. That's on the low end, and for U.S. Higher risk segments, it's a bit higher than that. We can move on. Nancy, I think we have another slide. I mentioned the derivative component, and this is a little bit of where we spent time with Joe and the panel as respects where folks can continue to focus their attention. What we had were a lot of exposures and issues to get our arms around. Kevin's been great helping on the M&A front and what that means for the overall D&O environment. It's usually the smaller cases and the things that we have to dispose of, and not the ones that drive the loss ratios for carriers. Market volatility, you could see some of the aggressiveness of the plaintiffs bar following that time frame that Kevin spoke about. Activist investors, some of that noise that companies were having leading up to and ending in 2019. And then you had the 2020 more drivers, a lot of Me Too privacy security issues. So things that were not on the plates of directors and officers as respects things that were going to hit their policies. All of a sudden, those things became event driven and reasons why plaintiffs would go after certain companies, even though their financial solvency and their quarterly guidance might be good. These issues now are coming to light, and companies are looking at ways to fight these type of cases off. Wildfire, for instance, is not one here in California that we thought would be a D&O driver, yet PG&E is an example of that, where they have publicly settling litigation as respects their issues with respect to wildfires and environmental issues. So there's a lot that's going on that are now part of the D&O dilemma that we want to talk about. Go ahead, Nancy. I think we can give folks the next slide. I mentioned what some of the analysts are looking at. You know, we're a public company too, and a lot of our strong competitors are as well, and they want to know what's going on in our business, and we're cautiously optimistic about 2020, but just some commentary about, and Melinda spoke to this a little bit when we were talking as respects ways that companies can deal with some of the changes that are happening to their D&O insurance programs, because a lot of changes are happening where carriers, if they are able to provide the coverage they're seeking, changes to limit to manage their catastrophe loss. They're seeking higher deductibles and retentions across the portfolio. Those loss trends are catching up to not only us, but other carriers. So it's making the population of insureds feel more tightened and more difficult for them to get the coverage that they need for these type of litigation events. So you see strong carriers like Zurich and Chubb and the London markets, Travelers. If you look at their results, they're also speaking to this as a social inflation, but also a loss cost escalator as respects the D&O environment. So it's challenging, and we realize that it is for clients. I think we want to emphasize with Joe and the panel that there are options for clients. There's ways to get D&O insurance to be meaningful and helpful. It's just very challenging right now. Go ahead, Nancy. Thank you. And I know Ignacio liked this slide because I know his team is working on this challenge as respects settling litigation. You no longer have just the run-of-the-mill stock drop cases being predominant. You now have a lot of state court cases, like Kevin mentioned, the federal suit in Delaware, maybe, and then you have the derivative component, where, as the slide says, it's not just a tag-along addition to the securities class action or their core filing. It's a driver, and it's a way for plaintiff firms to really get at the core of the company and see what's going on with their disclosures and the way the board is made up. And we'll talk about some of those issues and what some of the mitigations are for some of these things. And there are several top plaintiff firms that we see every day that are talking about not just smaller cases, but billion-dollar settlements. So those derivative suits that you may hear about settling, those are prominent, and they're often more difficult to track. Also, I think Kevin had a stat in his D&O diary that the parallel cases with a derivative were on the upswing. So we often see these derivatives as impediments to getting the overall case settled. So we'll talk about ways to deal with those too.
Great, thank you so much, John. I want to open it up to Kevin, Ignacio, Melinda, if you have any responses to what John just brought up, some of his concerns.
You know, I'm going to jump into where I was or where I am in the agenda just to offer a few comments. So D&O really comes into play at the front end when you're evaluating that you need to purchase it. As a director and officer, you want to make sure that you are complying with our perceived duty to try to both assess risk and protect against risk, and to try to purchase meaningful insurance. And it really, I think, knocks on your door and comes home when you have a claim, and you have to really at that time assess, what did you buy and what does it really mean? And so, at least in my experience, number one, as John indicated, it's getting, the market is getting tighter. It's getting more difficult to renew your D&O insurance. We have had to seek out multiple sources to obtain quotes, and the terms of the D&O insurance have changed. Premiums are higher, and the retention rates are higher. Now, many people buy insurance in general because of A, coverage, but B, probably one of the most valuable components of it is the defense and paying for defense costs. But I think at the same time that you're purchasing and looking for the D&O insurance, you also learn more when you have your first claim or more, and that experience will then better inform you as to what you purchased and what does it really mean to have a D&O policy. Many, I think, are discovering that the the terms of coverage aren't always what you think they are. The defense retention rates are high, and you find yourself paying out of pocket either in whole or in part until you either work out coverage disputes or learn that you don't have coverage for what you think you might need with regard to any specific claim. It's not uncommon for a company and directors to think they have coverage, and then maybe they don't, and so you're funding a litigation until you work out those coverage issues in general. So A, it's harder to get the coverage. B, you need to try to understand what you're really insuring against and assessing the risk, and try to get a good pulse for that. And B, your eyes are really opened up once you have that claim or two, so that you can really understand what this market is, what you're insuring for, and whether or not you've purchased the right kind of coverage. And many times you haven't. So as a director, I think we need to work with the Johns and the Kevins and the Ignacios to better understand the market, to better understand the risk, and then to deal with the litigation once you have an active claim.
Thanks, Melinda. Ignacio or Kevin, do you have any input as well?
So let me jump in briefly to talk about some of the trends that John was discussing, and that is, one of them is the multiplicity of fronts in a battle. As John mentioned, it used to be that you had if you had a stock drop class action, sometimes you'd have a companion derivative suit. That's now much more common. In addition, you have a greater panoply of claims, even with a single case. So you have a stock drop class action, you have a companion derivative suit, you may have books and records demands under Section 220 of the Delaware Code, or the state law equivalent if the company is incorporated somewhere else. You can have shareholder litigation demands. So there's a sort of greater menu of claims, even if you have, quote unquote, a standard stock drop case. In addition, as John said, larger derivative suits are becoming more common. That's typically because the stock didn't move dramatically, but there was some kind of corporate trauma. There have been several cases decided in Delaware in the last couple of years, which have gotten a lot of attention, where there is arguably a goalpost moving, where you have a board that wasn't on top of, say, a regulatory issue or a significant risk that the company faced, and then that regulatory issue led to a problem. The risk ended up having materialized, and bad things happened. And so we've had instances where there were cases about food safety, pipeline safety, things like that, that ended up in the case going further than what normally would have happened in a sort of a standard derivative suit. And there are a number of cases out there that have gotten a lot of attention. Certainly things about opioids and company boards overseeing risk that the company may not be complying with FDA regulations or the like. Similarly, there have been some settlements involving large derivative cases. There was a significant settlement involving the acquisition of Solar City. There are others that are sort of lurking. A couple of quick things, and I know we got a question about COVID, and so let me talk briefly about that and then hand it off to Kevin. We have, as Kevin noted, there's been a lull in the first half of 2020, and really that lull was in April and May. The first couple months of the year were sort of normal, or the new normal of the last few years. The COVID cases that we've seen have been not that many, but there have been some, and they've been targeted at companies which have either really gone up significantly because of COVID, and then there was an issue as to whether that made sense. So for example, companies that said that they had made great progress on a test or a development of a vaccine, and it turned out, well, there were reports that maybe they weren't as far along as people might have thought, and the stock, which had zoomed up, dropped, and then they're facing a lawsuit. Also, cruise line got named because of some of its marketing practices. So there have been some of those, but not a significant number, and certainly not companies that have had sort of ordinary bad Q2s, although or Q1s because of the impact of COVID. They've been some, but relatively few, because the market really priced in the challenges that a lot of companies face. I do think that the risk in the next 6 months to 18 months is those companies that, because of the nature of their business, have done very well because they have a work from home product or some other thing, and they're going to be sort of riding high. And that's when you have a greater risk. When things are going well, your stock price is strong, there's a lot of momentum and enthusiasm. So I think those companies really do face risk. The plaintiffs bar also, a couple of comments from some members of the plaintiffs bar have said essentially they're going to look for companies that are going to try to clean up their books. So there have been instances where people have talked about, because of the challenges, especially in some industries, there are going to be a lot of asset write-downs, asset impairments, goodwill impairments, those kinds of things. And some members of the plaintiffs bar have said they're going to be very active in looking at those and seeing if companies are essentially recognizing a problem that has existed a long time. Well, that's a risk down the road, but I think that it bears watching. Kevin, what did I miss?
No, you didn't miss anything. I actually just want to comment on some questions we got in. There's one question: can you give an example of a derivative lawsuit that had a significant settlement? And the first one that comes to mind for me is 21st Century Fox, which settled what was essentially a Me Too lawsuit against the board for essentially allegedly turning a blind eye to repeated example of sexual misconduct, sexual harassment by media personalities of the company. That case settled for $90 million, although truthfully, the corporate therapeutics, it's the rare case where I think the corporate therapeutics were arguably as important as the cash settlement. Given the context of this webinar, I think I should emphasize that $90 million was all paid for by D&O insurance, an example of how important D&O insurance could be. I want to tie something that John said to something that Ignacio said. John used the term event-driven litigation, and it's a term that people in observers like myself that have adopted to differentiate from financial misrepresentation cases. Historically and in the past, most securities lawsuits were about accounting misrepresentations or financial reporting misrepresentations. The number of restatements has declined every year for the last several years, so there's less of that kind of stuff for the plaintiffs to work with. So instead, they developed this, that if the company has an adverse event in its business operations that affects its share price, that constitutes, or that can be the basis of stringing together a securities fraud case. And the reason I wanted to emphasize this event-driven litigation, Ignacio was just talking about the coronavirus lawsuits. Well, there you are. Those are event-driven lawsuits. It is a big factor in that ramp up in the number of lawsuits we've seen. It's a challenge for the insurance underwriters. You can underwrite the accounting and finances of a company using publicly available information, but it's a lot harder for underwriters to assess the risk of an event that could the share price of the company. So really the only defense the underwriters have is pricing. You have to price for the uncertainty, and that's one of many factors affecting the current harder insurance marketplace. That was my comment there, Nancy.
Thanks, Kevin. And I do want to pause for a moment and welcome Joe Talmadge, who is the moderator for this webinar. Joe, let's see if your audio is working, and I'm happy to pass the baton to you.
Awesome. Thank you, Nancy. Can you hear me? Fantastic. Sorry for the technical difficulties getting online there. Kevin, Ignacio, you guys have commented on quite a few things as it relates to the AIG slides. A couple of things that we were talking about in the panel that I didn't hear addressed yet were some of the D&I trends. Ignacio, you had mentioned some recent fraud cases, some duty of care issues in that changing environment. Do you care to comment on any of those things that we discussed prior to getting prepared for this panel?
Sure. So I do think that there's sort of the goalpost moving Kevin mentioned Me Too cases. I think that that's something that's a significant issue that is both societal but also corporate, and we're going to see more of that. And I do think that it puts a greater burden on the board, because those tend to be more board issues. In many ways, if you think about the standard case where even if there's a financial restatement, but the company gave some guidance and it missed, there were statements about an upcoming product and the product had bugs or was late or something like that. But these tend to be more about corporate culture, the broader environment. And I think that ends up being much more focused on the boardroom, and it is a different challenge. And I think that what John and Kevin were saying is pricing hadn't reflected that. It may be reflecting it now, but a couple of years ago it wasn't reflecting. And so that is a new environment. And certainly for a board member like Melinda, who has to think about a much broader set of issues than a few years ago, it makes both the risks harder, but also a lot more work and challenge for directors.
That's right, Ignacio. I will just add that, like Kevin said, it is difficult for us to rate and price for specifically those board issues. But we do see a lot of momentum where there are a lot of reasons why boards should be diversified and diverse from a gender and racial standpoint, not only to avoid some of these entanglements, but a lot of investors are seeking out those type of investments where companies are showing that there's diversity in the boardroom and those folks are being proactively engaged. And there's a lot of correlation between companies that are performing better and in how diverse they are. So there's a recent round of litigation against some of the larger tech companies in our neck of the woods here, Ignacio, that I think Joe was referring to, where some of the plaintiff firms are actually saying, well, this is what you mentioned about diversity. This is your diversity plan. This was out there, and they're holding companies accountable to it. So it's a main driver now, and it's a way for plaintiff firms to see if companies' disclosures and accuracy is there. And like Kevin said, to kind of check under the hood and see what the environment is like and how happy and stable the workforce is and the investment community is with companies' actions.
Thanks, Ignacio. There's an additional question from the audience as it relates to the breakdown of companies that are private venture-backed firms, some of which were in the process of IPO or M&A, versus the public company data. I know we talked a little bit about some of the risks related to unicorn companies and some high-profile Silicon Valley companies. I don't know, Ignacio or Kevin, if you want to make any commentary about that risk as it relates to the public D&O arena.
I'll just comment very briefly, Joe, and just to emphasize that the statistics I had were focused exclusively on public companies. And that's really simply because that information is much easier to access. It's harder to get aggregate information about private companies. But the one thing I will say, in recent years, the SEC has made a point, and so in fact, private litigants, that the U.S. securities laws don't differentiate between private and public companies. The U.S. securities laws apply to securities fraud, whether the company is publicly traded or not. And there have been very high profile actions by the SEC, really, I think, for the purposes of reinforcing that concern. But typically in our world, the D&O insurance world, we perceive there being a significant difference in risk between private and public. But when you get these very large private companies, as we now have, the so-called unicorns, I think it gets harder and harder from a risk segmentation standpoint to view the world as that strictly divided into either private or public, because in our litigious environment, those high-profile private companies can face risk as well.
That's
and
great.
To follow up on that, boards of private companies, particularly those that are raising large amounts of money, I mean, there are private rounds that are much larger than initial public offerings. And so those boards are much more sensitive to the risk profile, insurance issues, and also their shareholder base. The changing nature of private company investors has changed the risk profile for private companies. You're just much more likely to be sued if you have newer entrants to the marketplace than if you have 3 venture firms that are part of the company, that have board seats, et cetera. That changing nature of your investor base is a factor in greater risk for private companies.
We have another question that came in that I think is, I'll let either Ignacio or Kevin take it. How should board members of SPACs think about D&O coverage?
I'm going to answer it first, Ignacio, simply because it's part of my daily life the last few months. I mean, I'm sure everybody listening knows that SPACs are the hot new thing, and that such a large percentage of the IPOs that are going out are SPACs. It's a different animal from a risk assessment standpoint. You know, the SPAC doesn't have employees, doesn't have operations. It's just basically a trust that's set aside for the SPAC transaction. I think the SPAC sponsors tend to underappreciate the extent of the litigation risk. My personal view is that the SPAC sponsors routinely underbuy the insurance, and where the risk comes from, usually it's not the IPO itself. It's not the period that it's holding the trust funds prior to the investment. It's when the time comes for the investment, particularly if there's a PIPE offering at the same time as the SPAC acquisition in order to raise additional funds. The risks and the claims relate to things such as, it turns out the company acquired was a poor candidate. It turns out that there were misrepresentations made about the operations of the acquired company. And then down the road, after the SPAC acquisition has taken place, if the go-forward company stumbles, the lawsuit that comes in may sue not just the directors and officers of the operating company, but may sue the directors and officers of the SPAC for issues surrounding the selection of the company or disclosures at the time of the transaction. So I think there's a lot of risk there. I think it's underappreciated. It is something that virtually on a daily basis these days, it's part of my life because there's so many potential SPACs and SPAC offerings out there. Ignacio, I'm interested in your perspective on that. That's an insurance perspective.
You know, well, I think that's all correct, and I agree with it. One additional wrinkle is because the business of a SPAC is to make an acquisition, and because the way it's going to work is it's going to issue a proxy statement and have its shareholders vote on the acquisition, I think that they're all going to be subject to M&A lawsuits. I saw one within the last week, which was a SPAC that is buying a company, and it got a standard merger objection suit that the proxy should disclose additional information about the target, et cetera. And given that the target is going to be almost always a private company, which doesn't have SEC filings, financials out there, et cetera, it's going to be a harder challenge than here's the historical information for a public company being sold or being acquired. So I think that all these SPACs are going to face merger objection suits. Now, the severity of those is often not very high, but still, it's a lawsuit. It's certainly annoying at a minimum. But I think that that's one risk. And I do think that there is a greater risk for SPACs in that then they're now, I think a lot of these, I wonder if the process of going public helps a private company get more prepared to be a public company than a SPAC acquisition. I don't know. I raise that as something to think about. But because one of the advantages of SPACs is that you don't have to go through the rigmarole of as long and drawn out process. I do think that there might be instances where the target isn't as ready. Now, SPACs have some advantages. They have usually very seasoned management teams that are ready to go, et cetera. But I also think that part of it is we're in a bubble. If you want to have flashbacks to 1999 and the dot-com bubble, look around the internet and see what people are saying about SPACs and why they're investing in SPACs. It's the Wild West again.
Yeah. Thank you, Ignacio. You know, there's a question that came in and around the pre-IPO, and you mentioned the pre-IPO risk, Ignacio, for companies that are thinking about going public. And Kevin, you made a commentary about the claims data, you know, being publicly available for public companies and not necessarily available for private companies. I do think, you know, RT Specialty, you guys have been tracking internally claims data both on public and private companies. Companies like Heffernan are tracking claims data on private companies. It is helpful to have partners that are tracking data that isn't necessarily out in the public forum to help in that decision-making process. So there is information out there. It's not always readily available. You kind of have to hunt it down. I think the other challenge that we're running into as a firm is privacy concerns in and around companies warranting for that data to be available, aggregated, used, and how that ends up coming into the decision-making process. So a lot of our clients, you know, will not want us to use specific data for our assessments. So that is a challenge on the private company pre-IPO side. I'd like to kind of take the panel into a different direction now that we've sort of laid the framework for where the market is at, what's happening, and talk a little bit about what from each of your perspectives, companies are doing right in this environment. As we think about this, you know, we have a D&O on the panel, we have an attorney on the panel, Kevin as an intermediary, and then I think even from an insurance company perspective, it would be helpful for the audience to hear, you know, what are companies doing that are good and right and improving the risk profile. So, Melinda, maybe as a D&O, would you mind kicking that one off and just commenting on, you know, the companies that you work with and sit on, what they're doing right in your perspective?
Yeah, and I will offer it from the perspective of private companies as well as you know, the bank. And a lot of what we are doing maybe right is working with people like Kevin and the brokers in advance and regularly. I mean, some of the companies that I've worked with have longstanding relationships with their brokers. And I like that unless that relationship isn't working, because then there is a documented and a well-informed history of claims in general. And that helps whenever you are purchasing insurance of any kind so that they can help provide that guidance. Assessing the risk and working with your risk officers and audit committees and audit officers is important. In addition to being able to make the case with the carrier, with Kevin, with John, so that you are making the case of what the company is doing right in terms of training, assessing risk, mitigating against claims, so that you can make the case for coverage in the first instance. Because this year, for the first time, I had companies that were having a difficult time acquiring this insurance. And let alone, like I said, redefining what they were buying and the premiums increasing and the retention rates increasing as well. I did see one of the questions from a member of the audience regarding risk to private companies and officers and directors. And I wanted to just comment on that briefly, is making sure that you are keeping informed, working with counsel, working with the Kevins and Johns, assessing the risk. I would ensure that you are getting some kind of coverage and that you are following all of the right legal guidelines. If you're a startup, working with the Ignacios, even though he's a litigator, but working with your corporate counsel and with your litigators to ensure that you are following all of the appropriate corporate formalities, so that if there is a problem, you are trying to protect the officers and directors from potential exposure. So those are a number of things that I wanted to throw in there, Joe, and including comment on that one question that came in regarding private companies.
Yeah, thank you, Melinda. Ignacio, do you want to comment on risk mitigation and your perspective on lockups?
Sure. So one of the things that is standard in an initial public offering is that there is a lockup, so that those shares not sold in the IPO are locked up for a period of 90 days to 180 days. It varies, but that's a standard thing. One of the issues that has surfaced in the last few years in particular, because of all of the cases filed in state court challenging IPOs, since state courts have jurisdiction over 33 Act cases, is what to do about lockups. And I think companies are starting to be more active about that. The reason lockups matter is as follows. If the only shares trading for, say, 6 months were issued in an IPO, then anyone who buys a share of stock in the market bought a share issued pursuant to that IPO. And so they have standing under Section 11 of the 33 Act. If, however, there is a portion of the shares that isn't locked up and is entering the market soon after the IPO, then somebody who buys a share of stock can't really trace. As a practical matter, in today's electronic markets, it's impossible to trace your shares back to the IPO. So if there are IPO shares and non-IPO shares traded out in the market, those purchasers who bought subsequent to the time there were non-IPO shares out there can't trace, can't have a Section 11 claim. And so even if it doesn't eliminate a case, it can make it smaller. It can eliminate portions of the class, essentially. It can reduce the size of the potential class members, and maybe even it's a way to get rid of the case. But that is something that I think companies need to think about much more actively than they have in the past. It's a different issue with the Spac, right? Because they're already publicly traded. There's already shares out in the market, and the shares being issued are to the target shareholders. Oftentimes they are locked up for a time, but so I think that SPACs are going to face relatively few Section 11 cases, or fewer Section 11 cases than standard IPOs, but they're going to face a panoply of other cases. So why don't I just hand that off as my plea to think hard about lockups.
Thanks, Ignacio. John, did you want to comment on maybe your perspective from the underwriting side and the insurance carrier side on what you guys are looking for and what you like to see in terms of companies doing the right thing?
Yeah, thanks, Joe. I thought Melinda phrased it well, and so we'll use the example that she outlined and say, okay, well, let's assume that the board is challenging management and founders the right way. They're in active discussions. They're moving things along. Like Kevin said, what do we do now? We're in a pandemic. We're in a challenging environment. How do we operate the company progressively, but still be conservative and avoid things that might stick us in the eye? So what we're seeing is that the biggest thing right now is disclosures and corporate communications. Again, obviously, like Kevin said, this is for public companies especially heightened because I think you have plaintiff firms that are looking at ways to pick apart what companies are saying and what they're doing. So we're looking at the ability for companies, are they using outside counsel? Are they using the general counsel's office? Are they doing everything they can to go through and look at what their known risks are? And are they communicating them first within the board and management in a work from home environment? It's not easy to hold all those meetings, but they need to happen. And then a lot of clients are doing that correctly. And then they're going outside to the investors and either pre-announcing or announcing on time, this is what we know, this is what it looks like, this is how we might be impacted. And to the betterment of a lot of companies that take that proactive approach, they're doing it right. They're saying, we don't know, we're going to take off the table guidance that we don't know, and here's what we do know. And a lot of those companies are getting a positive reaction, and you've seen the stock market kind of tip back up when things are positive and things might open up. And when there's an industry challenge and certain sectors are hit, those companies are going to move down and they're going to lose a lot of their upside, and people are going to be upset about the share price. But that doesn't necessarily mean that that company is going to be targeted for the reasons that I stated. They're doing their due diligence on their knowns. So I think that the concern and the challenge right now in the insurance community is that going back, I think Ignacio talked about the dot-com era and Kevin talked about 2000, is that we want to make sure that there's not a sentiment that companies are taking advantage of COVID to brush under the rug a lot of their own specific dirty laundry and issues. Are they dealing with things the right way, or are they taking advantage of a pre-announcement or a restatement to deal with issues that were going on already? So I think a lot of that kind of talks to what Kevin said, that there hasn't been as much litigation to start this year. And one of the reasons why we might think is that plaintiffs want to see a lot of what I just described play out. And sometimes that takes over a few quarters to see who really the good actors are versus the companies that are more challenged. So I think, Joe, most companies fit the mold of what I said, and they're doing the right thing. Some companies are challenged for more reasons because of the hyper growth, and they'll have to account for what happens when they come back down. So those are some of the drivers that we're looking at specifically at AIG.
Great, thank you, John. We've got about 6 minutes left before this panel was scheduled to be done. I did want to get to one other thing, and we're starting to get a bunch of questions coming through. So what I'd like to do is get to what we wanted to cover on the panel. We'll leave the call open beyond the 11 o'clock marker for those that want to stay past 11 o'clock, but to address all the question and answers that are coming in. The question I wanted to pose to the panel, and it actually was a question that came in, was, do we actually need D&O insurance? And I know that as a precursor to this panel, we talked about some recent announcements of companies that were considering just foregoing D&O. I think there's a lot of commentary in and around that and perspective on that. I'll start with Ignacio. Kevin, maybe if you want to follow on to that in terms of companies that are deciding to, consider side A only and maybe have a different thought process in and around purchasing D&O at all.
Yeah, happy to. And I'd want to hear Melinda's comments on this as a consumer and as an insured. But given the cost, it's only natural that companies start thinking about alternatives and whether they want to have as much or not any. And so I think that's only logical. I would think that directors would be very nervous about serving on a company's board if it had no D&O insurance at all, because that is at the ultimate safety net for them if the company goes bankrupt or because of legal reasons cannot indemnify them. So I think that is going without any insurance is a really big jump. I know that some companies are thinking about doing only side A, and side A coverage is only that for the individuals. It doesn't reimburse the company for expenses or settlements that it pays out, whether on behalf of the company or on behalf of the Ds and Os pursuant to indemnification obligations. That is a possibility. I think that most companies that look at that end up concluding, and John should speak up, that there isn't as much cost savings by just having pure side A as having more of a complete program, which includes coverage for the company as a defendant and also for the company in terms of its indemnification obligation. So normal, I would think that that's sort of a last resort. I think companies need to think through the alternatives and whether it's changing the nature of the coverage they have, increasing their retentions, maybe doing some co-insurance, doing some other things, as opposed to going the very big step of going certainly without any insurance or even just a pure side A. I'm curious to see what others. Melinda, you're the insured.
Yeah, I'm the insured, and I'm an attorney, so I see it from a different end, at least with smaller companies, okay? People are trained early on, whether it's a nonprofit or a private or a bigger company, is there D&O insurance before they sit on a board? Once you sit on a private company board, a VC-backed board, an SEC board, you're not only talking about individual liability, which, companies think, oh, it's a corporation, there's a corporate veil, it's going to protect me. And then you get hit with a claim, and then you find out the D&O coverage doesn't really cover what you think it does. You're going to end up paying the litigation defense fees, and you weren't expecting to. But it really hits home on the coverages. But then there's another economic reality, not only the cost and, of course, the financial condition of the company and what you're serving, but other requirements. There's other people looking at whether you have these coverages. Your lenders, your VC-backed companies, lenders that are really important to the ongoing financial viability of companies. They want to know that you have insurances available, including D&O insurance. And so there's a lot of different competing factors about whether or not you're going to secure coverage. So for the most part, the companies on which I've served, the clients who I work with, private and VC-backed and otherwise, are getting D&O coverage. It is difficult this year. We've got COVID and we've got all these market competing issues that I talked about earlier. It's more expensive. Many are finding out that if they have a claim, their D&O coverage isn't going to cover them. They're not going to provide the defense, and or the retention rate is so high that you might as well not even have coverage for defense fees, right? But for the most part, I think people are still erring on the side of having D&O coverage because of the ongoing financial viability, and especially any requirements or any of those third parties that I think are looking at whether you're dotting the I and crossing the T by having the D&O coverage, your lenders and your VC companies. That is ultimately, I think, in addition to risk assessment in general, but those other third parties are going to ultimately keep you probably buying it.
Thanks, Melinda. John, I wanted you to comment really briefly. We're coming up on the hour here. We're 1 minute over, but just before everyone gets off the line, companies are taking higher retentions. There's a different way to structure the tower in the form of co-insurance, which maybe doesn't always necessarily get talked about. Can you share your perspective on that philosophically from an insurance company point of view on the co-insurance strategy versus layering and what that sort of looks like on your side?
Sure. I know for Heffernan and for RT, it's kind of run of the mill, but we did bring back this semblance of tower structure. If you think about it, like Melinda said, to get everybody and all the parties happy with what you buy as a company for your directors and officers, sometimes you have to get creative and bring in more carriers or spread the risk around. And when you do that, sometimes the layering, like Joe said, benefits the company and their buying power and their ability to get limits and things done. So basically, co-insurance is another way of saying risk sharing. And a company, on behalf of its insureds, would co-insure a percentage of the risk so that the line is not 100% to the carrier. So it requires an astute broker and partner to make sure that the carriers are together on it and that it's working throughout the limit and the policy. But for instance, for example, 50% limit reducing co-insurance might allow you to buy the same or more limits, but your balance sheet would then be protecting and insuring half of that entity or that corporate risk, like Melinda said. Now, if that's viable to you, you get the benefit of the limits that you buy and your Side A attaches later on, so you're not degrading your limits, but you're actually buying more and participating more. And like Ignacio said, that may be a prudent decision if you don't want a high deductible. If your self-insured retention is moving to 10 or 15 or 20 million, depending on your risk, and you say, well, that's sector industry driven, that's not my risk. We haven't had that litigation track record, but I understand that's all that's offered to me. Maybe I want to participate more in the risk, and that's been a prudent decision. A lot of companies are asking for that option now, and at AIG and other primary carriers, they all have that ability too.
Great. We continue to get more questions. We're coming up on the final timing of our panel. I don't know if you have time to answer one more question, which looks more like a legal question. Ignacio, are you available to continue this for a couple more minutes?
Absolutely.
So there's a question that came in from the audience that says, can you discuss the liability of independent board members of venture-backed firms during fundraising round, especially if down the road with liquidation preferences, specifically where VCs whose firms have their own partner liability insurance seek to advantage the primary VC's investor over others? To what extent is the business judgment rule versus duty of care affect liability for the independent board members?
It's a great question and a very tricky subject, particularly on down round financings, other kinds of financings that raise difficult questions about duties of loyalty. On the insurance issue, typically any kind of venture capital partner sitting on the board of a company will be indemnified by the company, and their fund's insurance will essentially be in excess of whatever is provided by the company. And I think most indemnification agreements now have what's called levy language to deal with a case that popped up a few years ago in Delaware. But on the issue of those conflicts for private companies, down rounds and other kinds of more challenging financings raise a lot of conflict issues. There have been a number of cases in Delaware. If you want some fun reading, look at the Trados, Bloodhound, and Number 9 cases. But there are others that deal with instances where there was a down round financing or an acquisition, a sale of the company, where the common didn't get any money because the sale price of the company didn't clear the liquidation preferences of the preferred shareholders. Those typically are dicey deals. If there are some structural things that you can do to reduce some of the exposure, to the extent that you have independent directors, use them, create a special committee, have those directors run the process. Many small private companies don't have anybody on the board who's really going to be independent in the public company way, so to speak, but you can try to do that. You can try to have majority of the minority provisions or something like that. That has become common in public company deals involving controlling shareholders saying buying out the minority, and there's a majority of the minority provision. There are other things you can do that's called the MFW framework under Delaware. But typically those are things that you try to do to mitigate the risks. I think one of the things that private companies are doing better than they used to is surfacing these potential conflicts and discussing them. Sometimes there's no way around them because everyone around the board table is conflicted. But at least thinking about it and being deliberative about board conflicts and seeing, to the extent that you can, entering into some form of structural approach to either the deal itself or the process by which you get to the deal, so as to try to mitigate some of those risks for the directors and for the company.
Right.
Joe, I saw a question, Joe. I'm not sure if it came in when Kevin was handing off to me, but I thought it was phrased very well. It brings up a dilemma. I don't know if Kevin wants to talk about it also, but the question was worded very well, stating, what is the median size case? And it references indemnity, defense, and then I think the person was also thinking maybe of social inflation, and we talked about plaintiff fees. That's a moving target, but I don't know if the panel wanted to touch on that a little bit, because I mentioned for US listed companies, the data that we saw across the industry was moving more towards that median settlement, so that company in the middle of that year was in the $20 to $25 million range. Now, Kevin, I don't know if you agree with that's what a company should buy, but I think maybe that's where the question was going. And brings up an interesting dilemma that I know a lot of companies are trying to buy the right limits and not under or over insure, but that's a question that we get a lot.
Yeah, limit selection is always an important topic. Setting aside the question we were trying to answer before about whether you need D&O insurance, there's the follow-on question, how much do you need? And you should take into account things like median settlements, but also your asset size, your market capitalization, if you're a publicly traded company, Certainly, there are objective factors like that good advisors will make available to their clients to help inform that limit selection decision. But Joe, you and I both know that different buyers reach different conclusions about how much insurance is the right amount. And it's because there are different views of affordability and different views of risk tolerance. And so it isn't that there's a single right answer. It's more that the company needs to figure out what's the right answer for that company. And so I think those data points are important. And I think they're helpful because they're objective. So much of the other considerations that go into that decision are not objective. And so it is satisfying. And for certain types of buyers, it's particularly satisfying. If you're dealing with the chief financial officer, often they want objective numeric information. It's more satisfying, it's more meaningful to them. So all of those considerations are important. They're probably not going to be sufficient for most buyers, though.
Yeah, totally agree. Thank you, John. Thank you, Kevin. We are well over our 1 hour allocation of time. I'm going to wrap it up and thank the panelists, Kevin, Ignacio, Melinda, John, for all of your perspectives. I think we are operating in an incredibly uncertain time. I think there is a ton of data out there, which is now old data and doesn't really do a great job of predicting what is coming down the road. And I think that there is a lot to be said about cultural, philosophical perspectives, not only at the board level, but for the companies themselves in terms of how they are operating internally. As we move along in this world and try to navigate these challenges, again, I just wanted to thank each of you for your different perspectives because you're seeing it from different angles. So thank you. And Nancy, thank you for the Silicon Valley Directors Exchange for providing this forum. It's incredibly valuable and important to continue to push out education for our directors and officers. Thank you all.
Thank you, everybody. Thank you to the panelists, and thank you to Heffernan for co-sponsoring, and hope everyone has a great day. Thank you so much.